Hey everyone, welcome to our Asset Management Friday segment of the Passive Income Through Multifamily Real Estate podcast. I am your co-host, Kyle Mitchell, also joined by Gary Lipsky. This is a new segment that we recently launched that's focused on educating operators, building better systems, and becoming a best-in-class operator. Since we're also live on Facebook right now, make sure to type in any questions you have in the comment section below. Also, be sure to check out our Facebook group, Passive Income Through Multifamily Real Estate. All right, today on the show, we have Brian Burke. Brian, welcome, and thanks for being on the show.
Thanks for having me on.
Yeah, of course. So if you can start by telling the listeners a little bit more about yourself and what you currently do.
Well, I'm currently in a multifamily business. We have about 3,000 multifamily units all across the country in about 4 different states. So that's our current business. We raise money from high net worth individuals and family offices, and we acquire value add multifamily properties.
Very nice. Brian, let's talk about refinancing. When would you refinance, and what does that process look like?
Well, for us, we're looking at, it depends on how long we're planning to hold an asset. So for example, I'm a real big believer in a buy and watch investment strategy, which means we buy the asset and we improve the asset, we improve the income, and then we watch the market for the right time to exit. Usually that right time to exit is probably in 3 years or maybe even sooner or maybe just slightly longer, in which case a refinance doesn't come into play. But what happens if you get to year 3 and something like the coronavirus happens, or the unthinkable comes along and you're like, you know what, now isn't really the time to sell. What other options do we have? If I want to hold longer than 3 years, generally, we're going to want to refinance at that point so that we can return some equity to investors, which helps to do 2 things. One, it helps to increase their rate of return. But second, it helps to mitigate their risk because they can't lose money that they no longer have in the deal. So, for us, it's really about timing and how long we plan to hold.
Nice. Have you ever gone to trouble with doing a refinancing? So maybe it's you've held it longer than you wanted to, and then the coronavirus, something like that happens, or any situation you've been in the past that you've been like, oh no.
Oh, well, I've been at this for 30 years. So I've had my share of oh no moments. And yeah, in fact, one comes to mind clearly. We had a property in Houston. We were just in the midst of refinancing it when Hurricane Harvey came along. And, Hurricane Harvey, kind of like the coronavirus, what it did to that local market, it basically shut everything down. All the businesses closed, employees were getting laid off, hours reduced. You couldn't get around anywhere. People were kind of sheltering in place. The evictions were shut off because the courthouse was damaged. So in a lot of ways, it looks kind of similar to some of the events that we're seeing today. And of course, this happened right in the middle of our refinance. We'd already had the approval and we were just kind of marching towards closing. And then that happened. And the lender retraded the loan and tried to walk back the loan amount by a couple $1 million. And, our assessment at that point was, that's not enough to make it interesting any longer. And I also think this is a temporary situation. And when we come out the other side, we could probably do this again and come out looking a lot better. And ultimately, that's exactly what we did.
So how much longer did you hold on to that property? And then did you sell it at that time or did you refinance?
We refinanced ultimately. That about a year later, we came back and we refinanced and we got a loan amount, which was essentially the size loan amount that we were going for when we were in it the previous year. It's just this time we made it all the way to closing. So that loan ultimately closed. We held the property for another year or 2 or however long I guess it's been 2, and then sold. In fact, kind of funny story. We just sold it on Friday and got the wire this morning. So
congratulations.
Yeah, thank you.
Very nice. So how many years did you hold that property before you ended up refinancing?
It was so we were initially refinancing at about year 2 1/4, and then we ended up completing a refinance just after year 3.
Okay. And what kind of the fees and rates do you typically see when you're refinancing?
Boy, that's a moving target, especially in today's climate. But generally, what you're going to see, right now, what we're seeing. I'm a believer in floating rate debt. There's a lot of people like fixed rate debt because they like the certainty of knowing what their interest rate is going to be. They're not liking it so much right now because all my payments are coming down while all this is happening in the economy because we use floating rate debt. But certainly if rates go up, right now what we're seeing on the floating rate side, and this is what I can speak to the best, is LIBOR plus around 2.7 to 3.0 for agency debt, and probably about 50 bips higher, give or take, for some bridge debt sources.
And do you see any downside of using floating?
I don't. I mean, the downside to floating rate debt is you take on interest rate movement risk on the upside, right? I mean, interest rates could go up, causing your payments to go up. That's the risk. But to me, I find a lot more risk in fixed rate debt because fixed rate debt comes with yield maintenance, which basically means you're going to make sure that the lender gets paid all the interest they were due for the term of the loan. So if you take out a 10-year loan and you want to sell it year 2, you've got 8 years of interest that lender is going to be missing out on. And guess who's going to be paying for that? You are, as the borrower, through a defeasance or a yield maintenance transaction that's going to cost you millions. In fact, we bought a property last year. The seller had a $11 million loan that was a 12-year fixed rate debt. They were selling it like year 2.5. Their yield maintenance penalty to get out of that loan was about $2.5 million. And wow, that's a lot of money. So to me, the risk of having to eat a yield maintenance penalty far exceeds the risk of incremental interest rate movement.
Right. And you could buy a cap anyway.
We do buy a cap, yeah. So you're right. We're capping the interest rate. So we have some limits to the amount of how far to the upside those rates can go.
Right. Great. Kyle, I'm going to pass it on to you.
All right, perfect. I'm going to ask you the same question we ask every guest is, what is your asset management superpower?
Oh, boy. I think our asset management superpower is that between our core team here, I've got 3 executives that are on my team that have been in this industry for up to 40 years each. We've got 106,000 units of multifamily experience. We've survived more market cycles than I can count, and we've done it without losing any investors' money. So I think our superpower is survival and making sure that we get to the other side of adverse events such as the one we're faced with today.
Yeah, awesome. And maybe any advice for those going through this for the first time? This whole coronavirus thing is the first time for a lot of people, but as far as going through this type of cycle?
Put your seatbelt on because it's a turbulent ride. It's none of this stuff is easy. I suppose if it were, everybody would be doing it. But what's going to happen in this cycle is some are going to survive and some are not. And those that do may find themselves growing much greater than they ever would have grown had this adversity not materialized. So if you can survive this, which I hope that all the listeners do survive this, if you can survive this, you'll find ultimately it will be boon to your business to make it all the way through. So, don't default on your loans, don't lose your investors' money, and you can grow your business more than you ever thought.
Perfect. Thanks for coming on, Brian, and sharing some value on the subject of refinancing. So today, 3 things that I learned is be a buy and watch investor. And I like that because it means your business plan's forever changing, right? You don't stick to one exit strategy. You need to understand what the market is doing at that time. Refi typically after 3 years to mitigate risk and increase returns. And then you like floating debt, which we like as well, because you really get to avoid that yield maintenance on the back end, which I think a lot of people don't plan for. And when it comes time to pay that, it's big trouble. So please tell the listeners to find or where they can find you more. Please tell listeners where they can find out more about you.
Yeah, sure. No problem. The best place is on our website. It's praxcap.com. It's praxcap.com. Or you can find me floating around answering questions on biggerpockets.com or on Instagram, Investor Brian Burke.
Perfect. And to all our listeners out there, thanks for listening in. If you like this episode, please head over to iTunes and Stitcher, give us a like, subscribe, and a review, and that'll help us grow our audience. We'll talk to you next week.